I'm Russell Clark, and this is VixShield's Morning Outlook, where it isn't news till we talk about it. Good morning, traders. Another week in the books. Let's see how we did. You can already feel it, can't you? That slight wind-down energy that hits every Friday. Markets tried to stay glued to the same range they have been living in for days now. Bitcoin slipped below 80,000. Oil risk premium climbed on fresh accusations out of the Strait of Hormuz. A federal court just struck down those broad 10% global tariffs everyone was watching. And yet here we sit, with our rapid skew AI engine flashing a clear place signal for today. That's right, entry gates passed. RSAi-verified strikes are locked in. After a week of geopolitical fog, sticky inflation readings, and bond traders resetting rate cut expectations, our system says we step in. Not because we're reckless, because the math, the term structure, and the discipline all lined up. And that's exactly why you tune in. While the rest of the world is still guessing, we have a methodology that has been battle-tested through 20 years of these exact kinds of weeks. Let me take you through what the big money was doing while you were sleeping. Overnight, European futures opened soft. Asian markets reflected that same hesitation. The court ruling on tariffs sent a clear message. Trade-sensitive names took another look in the mirror. At the same time, Iran pointed fingers at the United States over ceasefire violations near Hormuz. That single accusation lifted the oil risk premium and reminded everyone how quickly shipping costs, energy flows, and safe haven bids can flip. Remember what we talked about earlier this week, those $7 billion in unusually timed oil bets that caught the DOJ's eye. Those same tensions didn't vanish. They simply carried over into the pre-dawn hours. A lone actor incident tied to Iran grievances added domestic tension. Remittance flows to India held steady so far, which is one small mercy in a region that has seen tanker attacks and flight cancellations this week. But the message from the overnight tape was unmistakable. Risk sentiment is fragile. The big boys trimmed exposure quietly. They didn't panic sell. They simply reduced the beta in their books. While retail traders scrolled headlines and wondered if they should do the same. Crypto felt it first. Bitcoin broke below that psychological level we had been watching. That dragged sentiment lower across risk assets. Gold, on the other hand, found fresh bids. You know what that tells me? The smart capital is still hedging its geopolitical bets, even while the equity indices refuse to break out or break down. Strong contango in the volatility term structure helped keep the fear gauge from exploding. VIX came in lower than yesterday. That pullback is exactly what our iron condors love to see. Now let's talk about what the big media is feeding you this morning versus what's really happening. CNBC and the usual suspects are probably leading with mortgage rates dipping on hopes of war's end. They're framing it as relief. They're painting a picture of calm returning. But step back with me for a second. We have persistent inflation measures telling two different stories. We have a new Fed chair in Kevin Warsh, who, according to veteran brokers, may lean toward printing money rather than cutting rates. We have April jobs data due at 8:30 with a modest forecast. And we have Beijing flip-flopping on Iranian sanctions right before a Trump-Xi summit. The media wants you to believe the story is simple. Either everything is fine or everything is about to collapse. Both narratives sell clicks. Both keep you glued to the screen. But we know better. The reality is messier. Policy friction, court rulings on tariffs, and Middle East choke points are all live wires. They create volatility that institutions can trade around while retail gets whipsawed. That's the trap. They want you emotional. We stay disciplined. That's why our community has an edge. We don't chase the headlines. We collect premium inside ranges our RSAi engine identifies in real time. Let's zoom out to the geopolitical landscape because this week has been a masterclass in interconnected risk. The Trump-Lula meeting earlier this week was described as productive on trade, yet Canada's $4 billion relief package signals the retaliatory cycle is still spinning. Saudi Arabia stalled Project Freedom. China and Russia stand ready to veto any Hormuz resolutions. Iran tightened vessel rules and canceled flights. A Chinese oil tanker reportedly came under attack. These are not isolated events, they compound. Each one adds a layer of uncertainty that keeps the volatility premium alive, even when the VIX itself pulls back. Bond traders have been aggressively resetting rate cut expectations. Fed speakers like Cook and Goolsbee are on tap today. Their words could move markets more than any single data print. Meanwhile, Berkshire's operating results under Greg Abel offered a quiet, conservative bright spot amid the noise. Quality businesses still execute, but the broader transmission of policy uncertainty into higher input costs, delayed consumer spending, and elevated corporate caution is exactly what we have been warning about all week. This environment, this exact mix of contained but live tail risks, is precisely why our iron condors are built the way they are. They don't require us to guess direction. They simply ask us to define a range and let time and mean reversion do the heavy lifting. Our methodology doesn't fight the market. It flows with the natural ebb of volatility. When the term structure shows strong contango, like it does right now, it tells us the market expects volatility to stay contained in the near term. That expectation is what we monetize. And today the signal is clear. All three tiers are active. VIX at 17.17, elevated but still below 20. Conservative tier is green, safe to place. Balanced is yellow, tradable, but size down if you are cautious. Aggressive is yellow, tradable with extra caution. RSA has done the work. The strikes are verified. The credits are live. We step in with discipline, not hope. This is why we're here, folks. This community. You and me. The ones who refuse to let the big media or institutional noise dictate our emotions. While everyone else is doom-scrolling tariff headlines or obsessing over Bitcoin's latest tick, we're focused on one thing: capital preservation and consistent income inside defined risk. That's what separates us. We built this together because you can't exactly talk about rolling temporal theta or layering adaptive VIX hedges at the family barbecue. But here, in this tribe, we speak the same language. We respect the fragility curve. We understand that bigger isn't always stronger. Sometimes the smartest move is staying inside our edges and letting the math work. I want to give you a quick weekly scorecard before we look ahead. This week delivered 4 trading days. We saw 3 place signals and 1 hold. The narrative arc started with complacency near record highs, moved through genuine geopolitical scares around Hormuz and Iran, saw sticky inflation reinforce a higher for longer Fed stance, and now ends with a modest pullback in the fear gauge and a fresh place opportunity. Not a bad week at all. We collected premium on the days the gates opened. We sat on our hands when they didn't. That's how you protect capital over time. Now for the weekend risk assessment. Keep an eye on any escalation in the Strait of Hormuz. Watch whether those suspiciously timed oil trades draw more regulatory heat. Monitor overnight futures for any knee-jerk reaction to today's jobs print or Fed speeches. Geopolitical fault lines don't close for the weekend. Neither do currency swings or potential tariff retaliation headlines. But here's the good news. Our ALVH layers, even if not fully detailed today, remain part of the longer-term shield. We don't have to be heroes every single day. We just have to be ready. So here's what we're watching closely as the session unfolds. How the S&P digests the jobs number. Whether Fed speakers reinforce that patient, higher for longer rhetoric, or slip into something more dovish. Any follow-through on that court tariff ruling and how it ripples into trade-sensitive sectors. And of course, the VIX reaction. A spike back above 18 on any headline would tell us the market is taking the geopolitical risk more seriously. We'll break it all down in today's closing episode. You know, it's funny. After a week like this, some traders feel exhausted. I feel energized because every layer of noise, every contradictory headline, Every court ruling or diplomatic standoff just reinforces why our process matters. The big boys want you emotional. They want you reaching. We don't reach. We respond. We place when the engine says place. We protect when it says protect. And we do it together. And be sure to listen for any breaking news from Miss Vicky. These signals and insights are for educational purposes only and are not financial advice. Past performance is not indicative of future results. This is VixShield, your daily protection against market uncertainty.